Thank you all for joining today's webcast, The Benefit of Investing in Grocery Anchored Commercial Real Estate, hosted by founding managing principal Anthony Grosso. He will be presenting the benefits of investing in grocery anchored commercial real estate, a company overview, and unveils their Grocery Anchored Opportunity Fund. Mr. Grosso is co-chairman and managing principal and founder of First National Realty Partners, one of the nation's leading commercial real estate private equity firms. He has been involved in all phases of FNRP's development since its founding. Anthony Grosso is widely regarded as one of the leading authorities and thinkers in the commercial real estate private equity industry today. And under his leadership, FNRP has grown to become one of the preeminent commercial real estate private equity sponsors in the United States. Anthony, I'm going to hand it over to you. Good luck.
Thank you so much, Jeremy, and thanks for having us. You guys run a great organization. Happy to be here today talking a little bit about our firm and overall the benefits of investing in grocery anchored CRE. So again, my name is Tony Grosso. As Jeremy mentioned, I'm one of the co-founders and managing principals of First National Realty Partners. We're a nationwide grocery anchored shopping center acquirer, have about 55 properties, over 7.5 million square feet currently, as we speak. So happy to be talking to everybody here at Fly about grocery anchored CRE. So let's dive right in. Just a quick disclaimer before I get going. This presentation should not be considered a solicitation to purchase securities. We can only do that via private placement memorandum, pretty standard. And we only work with accredited investors, if we're talking about individuals or obviously institutions as well, with the income and net worth requirements up on the screen. So as a way of saying thank you for everybody coming on and viewing the presentation here today, we have a couple of bonus items, gifts that we wanted to give away. My partner Chris and I have co-authored 2 books. Our first one was Valuated Real Estate. The second one is called The Art of Commercial Real Estate. Happy to give everybody a free copy of that. They retail on Amazon.com currently. And then we also have 3 great reports that we put together that we think add a lot of value and make a case for commercial real estate partnerships, private equity, and grocery anchored retail overall. So if you'd like to get a copy of this, Tom from our marketing team is standing by. I guess there's a chat feature or something you can write in. We're happy to get everybody a copy who's interested. So here's our agenda for this afternoon. Don't want to take up too much of everybody's time. I want to be about 30 minutes on my presentation. Then we'll open up for a little bit of Q&A. We'll talk about the benefits of grocery anchored CRE, why right now in the cycle it makes more sense than other asset classes like multifamily, industrial, and office. We'll talk a little bit about the firm. We'll go over our fund that we recently launched in Q4 of last year, moving along from individual syndicated deals, and kind of our investment thesis. I'll then kind of get into why we think it makes a lot of sense for institutional high net worth investors to get involved in our fund and grocery anchored real estate overall. I'll reveal the deal room so you can actually go on and make an allocation or schedule a time to speak with myself, my partner Chris, or our partner Ken, who's our head of investor relations, and then I'll open it up to a little bit of Q&A at the end. So let's talk about the benefits of investing in grocery anchored CRE. Grocery anchored retail is pretty straightforward for everybody who doesn't know it. It's a shopping center that is anchored by a grocery store. We love working with national tenants. Traditionally, the leases that we're going after, we either have a long-term lease in place with the anchor, which adds a lot of stability, or we know prior to going into the deal that we're able to extend the lease. So that's going to be part of our business plan. So we're able to leverage off relationships with national brands. Grocery anchored retail, we think, makes a lot of sense right now because of this necessity-based nature that it provides to the customer and the consumer. You look at what happened in COVID. Our centers held up really well because they're anchored by grocery stores, drugstores, and essential daily needs type retail. You hear a lot of talk about the retail apocalypse and online and all this stuff. And what we found on the other side of the pandemic is that our centers we've seen a lot of cap rate compression and the values have gone up significantly. So when we talk about grocery anchored CRE, we're looking for the number 1 or number 2 center in a market. So it's got to be dominant. We're only going after institutional quality assets, typically at least $1 million in net operating income. Nothing less than $15 million. Anything smaller, the economics don't make a lot of sense for our operating platform. We want it to be necessity based. If there's a grocer and then there's a bunch of non-necessity type names, it's probably not going to be for us. We're not really looking for power centers. We're looking for more neighborhood community type centers. And obviously, as I mentioned, we only want to work with top national brands. We have a nationwide acquisition focus, so we love working with national tenants. It really fits, our leasing and acquisition plan. So there's a couple of reasons why we think grocery anchored makes a lot of sense right now in the cycle. A couple of different reasons here. Number 1, I mentioned necessity, stability. resistant against recessions. It's kind of a defensive play. Regardless of what happens with the broader economy, people are still going to need to go out and buy groceries and take advantage of other necessity-based type uses. So as we saw throughout the pandemic, that grocers, our sales are up 20, 25, 30, 35% in some locations. And, the same is true with a lot of other essential type tenants. So you kind of have a hedge against a recession, and it's a little bit of a defensive type play in our opinion. And then the last piece is, ties into e-commerce and what's actually going on with our shopping centers and what we're seeing play out and why we think it makes a lot of sense right now to get into these type of assets is today's shopping center is becoming the last mile distribution facility for e-commerce players and brick and mortar players as well. We're seeing a lot of delivery, Instacart and Uber Eats and all this different stuff. We're also seeing stores like Target are fulfilling 95, 96% of their customers' orders online through their store network. So the big advantage that these national retailers have, these grocers and big box players like Walmart, Target, is that they have a phenomenal group of a real estate portfolio and assets that they can leverage off of, where Amazon is trying to get into the space and get closest to customer. And the reason why shopping centers do really well as a last mile distribution facility is because of their proximity to the customer. You think about the daily needs shopping center and all the population and the rooftops that surround it. It's kind of like the center of town. So it makes a lot of sense to us as time goes on that these will become the last mile distribution facilities of tomorrow. And it's not just the grocers, it's the smaller tenants as well. So we like the fact that it kind of has this e-commerce slant, but it also has a lot of runway to go as it transitions into the last mile distribution. It becomes a hybrid of, delivery, in-store pickup and then online delivery as well. And then obviously coming into the store to shop as well. So these are obviously a little bit generic kind of real estate benefits, but the beauty of the deals that we do is that they distribute income from day one. We typically do value add and core add type of assets. We're not doing ground up development or super opportunistic stuff with no cash flow. So we're distributing income from Q1 right away. Obviously the tremendous tax benefits, namely depreciation. We do cost segregation studies on all of our deals. So our partners really like the nice paper loss they take in the early part of the holding period. We can force appreciation. I'll get into our platform a little bit and how we do that. And the one thing that's nice about retail versus other asset classes is that you're typically out of your anchors getting really nice long-term leases. It's not uncommon to see 20-year deals still, easily 10, 15 deals we're doing day in and day out. So continuing on with some of the benefits of grocery anchored CRE, one of the great things about the essential use of the tenants that we go after in our shopping centers is that the credit risk is significantly reduced by national brands. Whereas, believe it or not, the industrial market is made up by a lot more mom and pop or local or regional type businesses. The space that we go after is predominantly dominated by credit type tenants. So we like that credit profile. We're able to analyze, publicly traded companies' credit, really see who's performing, who's not performing. So it gives us a little advantage on the intel front. You've got reduced cyclicality. As I mentioned, in a recession, people are still going to go to the grocery store. They're still going to go to the drugstore. They're still going to get their hair cut. So these daily needs type uses are going to do well. And then finally, the ecosystem from a tenant standpoint is that the grocers bring in a lot of traffic, and then the tenants alongside them obviously benefit as well. Additionally, outside of just the credit-worthy tenants, all the deals that we do, we really look at credit when we're underwriting these deals. And if we see a grocer where maybe it's a subsidiary guarantee, not a corporate, it's probably a deal that we're going to want to stay away from. We really believe in having, a nice, strong income stream, and a big piece of that is obviously the credit of the tenant that underlies on that lease. The great thing too is we also have consistent and increasing cash flows. We can go into a property, we can lease space, we can spin off out parcels, we can give a tenant CI dollars and push rents higher, all in the name of growing net operating income. So we might go into a deal and we're making 6, 7, 8%. And by the time we've repositioned the asset now on our basis, we're at 11.5, 12%. And then we can obviously spin it off at a lower cap rate. So the cash flow can go higher. I've mentioned a couple of times that it's resistant to economic downturns, say, compared to other classes like hotels and office buildings. And there's a lot of value add opportunities that we specialize in unlocking, and mentioned out parcels as well. And the great thing about all the leases that we do is that there's built-in rental increases. A big thing for a lot of investors in today's current climate is keeping up with inflation. We saw inflation reported at 6.2% last month, probably going to be even higher than that. based on a lot of different other professionals. So the great thing about these leases with these retail tenants is that we're building in increases either annually or every 5 years, so that we can not only increase net operating income through leasing space and value add initiatives, but also through increasing rent just naturally as the lease term plays out. You've got that great inflation protection, potential for capital appreciation. And because it's a private deal, you're not dealing with REITs, the ebbs and flows of the public markets, a million buyers and sellers and instant price discovery, significantly less volatility that you find obviously with a public deal. And obviously all of our deals, our investors are 100% passive and they get the leverage off of our platform. Speaking of the durability of grocery anchored CRE in COVID, during the height of COVID, let's say April of 20 to June of 2020, a lot of larger owner operators in our space had their collections drop down to 50%. Our portfolio, really due to the mix of essential type uses, was resilient. It stayed around 80%. So even in the bottom of the recession, a global pandemic, we were able to hover around 80%, which we think is really, really strong compared to our peers. By 2020, June of 2020, we were up above 90%. And now we're back to normal historical collections rate. So pretty much within a quarter and a half's time, we were able to kind of hit bottom and rebound out of it. And it's just been a frenzy on the leasing front ever since we've kind of, I don't want to say come out of COVID, but on the other side of the most severe portion of it. So a little bit about FNRP at a glance. About our company, we're in 17 states. We've got, it says 50 assets here. We're at about 54, 55 assets, about 7.5 million square feet. And the current portfolio on acquisition cost is $935 million. I think when you calculate the upside that we have in our portfolio, which is, I think, pretty significant, especially some of the appreciation we've seen with cap rates trending lower on the back end of the pandemic and grocery anchored really being in vogue, you know, it should exceed $1.1 billion in current portfolio value. The 935 is on acquisition value. 55 properties, as I mentioned, and you know, these all of our deals produce cash flow from day one. We're distributing right out of the gate, even if it's for a shortened quarter. So the deals that we've closed in Q4, at least on the halfway or 2-month point, are going to get a distribution in January for Q4. So we really like deals that produce cash flow. Kind of fits into our investment thesis of keeping up with inflation. We work with over 1,200, actually, it's 1,000 investors on the screen. But I think we're at 1,200 different high net worth and institutional investors have taken a piece of an FNRP deal, whether through our new commingled opportunity fund or through our individual syndicated transactions over the past 6 years since my partner Chris and I started the company. We've paid out over $25 million in distributions, and we currently have $2.4 million square feet in our current acquisitions forward pipeline. We have 2 really nice deals that we're bringing out at the end of the year here. One actually was launched today. Really nice value add deal anchored by Safeway. So a little bit more about the firm, so you kind of get a feel for the operating platform. I've mentioned some of this, but we're a vertically integrated opportunistic sponsor. We're based out of Red Bank, New Jersey. I'm dialing in from my house in Monmouth County, New Jersey today, but we're really all over the country to go along with the nationwide acquisition focus. We're about 90 professionals now on the team, and we're hiring people in California. And we just hired guys in South Florida, Philadelphia. So it really is a remote company, but our headquarters are based in Red Bank, New Jersey. And I've mentioned the size of the portfolio as well. Here's the leadership team, my partner and fellow managing principal and co-founder, Chris Palermo, Andrew DiNardo, Ken Chapman, our managing principals as well. Our chief financial officer, Deepika Bajaj, Kurt Padavano, chief operating officer, was with Advanced Realty for 30 years. Jared Feldman, our chief investment officer, round out a really nice, talented group of passionate professionals focused on the grocery anchored retail space, and right about 90 professionals on the team right now. From an experience standpoint in totality, we've worked on over 40 million square feet of deals, 81 years of experience, 10 billion plus transaction volume experience. So one of the questions that I often get from potential investors is what makes First National Realty Partners unique? And the first thing I always say is the people that we've assembled, because honestly, that's why we're really, I think, successful. We get great people. We've been able to poach them throughout the pandemic from other operators and just assembled a really, really good team of people. But really, it breaks down to these 3 things. It's kind of like a 3-legged stool. The first is something called we call the dragnet acquisitions model. This is the way that we acquire properties. The second is something called tenant-centric value-added investing. This is kind of how we add value at the property level that the average bear really can't do, and I'll touch on that in a minute. And then finally is the way that we approach our business, and that's to be totally vertically integrated up and down the line. We call it FNRP 360. So let's touch on these very briefly. A little bit about the dragnet acquisitions model. This is the way that we acquire properties and how we kind of look at the acquisition model, because it's a big piece of what we do. We have a nationwide acquisition focus, and we're very, very specific in what we go after. If a deal doesn't have about 60 boxes that need to be checked off to get investment committee stamp of approval, and if it doesn't have one of those boxes checked off, we simply move along from the asset. So in order to find that very specific target that we're going after, you have to source a tremendous amount of deal flow. And Jared, our Chief Investment Officer, Matt Annabelle, who run acquisitions for us, do a phenomenal job of building relationships with owners and operators, the brokerage community at large, banks, lenders, attorneys, anybody who touches broken real estate, that we can leverage a relationship to find deal flow. So we look at the country like it's a sandbox we're playing in. We run our dragnet over the country. And what happens is most of the deals fall out of that net for one reason or another. Maybe the anchor sales don't make sense. Maybe we get inside intel on a deal that the tenants are leaving. It's not going to work out long-term for them. The returns don't make sense. The demos are too light. There's 60 different reasons why a deal could fall out of bed. And once we're done running that dragnet over the country, whatever's left in that net is ultimately an FNRP deal. And we go after, we make offers very aggressively and try to grab the deal. Here's some recent acquisitions. It's actually a little bit delayed. We just closed on 2 deals last week. 3 deals we're closing this week, 2 today, and then 2 more actually next week as well. So I've been active in December. Did a Lidl deal in the Atlanta MSA, Whole Foods deal in the Midwest. Let's see, Kroger deal in Bloomington, Indiana, awesome asset. Everybody today should have access to all of our historical deal flow, our REO schedule, past deals that we've worked on. Happy to furnish anybody who's interested with all of the historical portfolio activity. So the second thing, and this is really a huge piece to what we do, is something called tenant-centric value-added investing. And I mentioned that we're vertically integrated, and I'll touch on that in a minute. But a huge decision that my partner Chris and I made a few years ago was to bring all leasing in-house. We were using third-party brokers, and there was just a tremendous amount of inconsistency. You'd have one group that was excellent and did a good job, very professional. You'd bring in another group in a new market you hadn't worked in, and you wouldn't have the results. So we said, you know what? We cannot have this type of inconsistency. If we don't perform on a property, I want to know it's on us. So we brought all leasing in-house, and we've created this program that we call tenant-centric value-added investing. And I mentioned we love working with national tenants. The reason being is a couple. Number one, we can get tremendous amounts of intel that the average bear can't, the average sponsor can't when they're looking at a deal. We know who the horse's head, the key real estate people are at all these different national retailers. And whenever we acquire a property with a new national retailer, we make it a point, Sam Collier, who's our head of national accounts, you see up on the screen, to get out there and really build relationships with these key people at these national companies. What that allows us to do is when we're looking at a Safeway deal or a Home Depot or Walmart deal, we're not just bidding on it based on what a broker tells us at an OM. We're able to really get the inside scoop and story of what's going on with the property. And if we see a bunch of national tenants at a site, and we go up and down the line, speak to them, and they say, you know what, this is not a long-term location. We're not performing here. Obviously, it's a deal we're going to move past. So I think that that's really the key here. We're getting intel using these national tenants. It's not the deals that we're doing. It's the ones that we're staying away from that maybe look good to the average sponsor. So we're able to use intel from these relationships, which is huge. Second thing is obviously we can do more deals. Compared to other publicly traded REITs and guys that are much larger than us, we do really, really well in leasing from square footage and deal standpoint every quarter. And then the last piece is we can do portfolio reviews with these nationals. We can take big lots and say, hey, we don't just have one opportunity for you because we're a one-off mom and pop landlord. We have this whole portfolio of opportunities, say 7 different situations that fit your parameters we think would be a great fit for you. So they're a little bit more motivated to speak to us than just the average mom and pop landlord. And this is what we call tenant-centric value-added investing. So the final piece to what we do that makes us unique is something called FNRP 360. And it's a fancy way of saying we're vertically integrated up and down the line from acquisition to disposition. We can act in all facets of the commercial real estate process, investor, developer, manager, et cetera. Whether it's accounting, property management, legal, another big one, like leasing, asset management, acquisitions, dispositions, debt origination, anything that we do more than one time, we iterate more than one time in the commercial real estate process, we found that nobody cares about your assets or your process more than you do. So we've brought it in-house. And I think it's really moved the needle in developing a world-class real estate platform. I remember, just to give an example, when we were earlier in the business, we were using third-party legal. We're going to close on an $18 million transaction, and the attorney couldn't give us his attention because he was closing somebody's, $500,000 condo. So Immediately after that transaction, we made the decision to bring all counsel and the legal in-house, and it just allows us to, incrementally get better up and down the line. It maximizes asset performance and it improves investor returns, which is obviously the aim here. So I want to touch on our Opportunity Fund very briefly here. Kind of the reason for coming on today is to tell you guys how you can get involved with First National and get involved in a broad smattering of our opportunities. We're targeting 12 to 18% targeted annual returns, cash distributions plus upside. From a distribution standpoint, all of our deals are going to have cash flow from day one. We'll target 6 to 9%. And all the deals that are going to be in the fund will be a 3 to 7 year targeted hold, core add, value add type situation. We'll be raising $50 million. This is our initial fund coming off of individual syndicated deals. I mentioned the returns here, a 3 to 7 year hold. And our thesis is pretty straightforward, okay? We want to go after well-located, dominant daily needs and community shopping centers. And we want to play on what we think is a long-term trend of grocery anchored retail and essential retail are morphing more into a hybrid type of product. Between last mile, between using alternative uses like medical and gyms, experiential uses, play off that trend as time goes on. And what we think is going to happen overall in the space is that these centers are going to trade more in line with industrial multifamily. I don't know if they get so tight to 3 cap. I hope they don't, because there won't be anything to buy. But what's going to happen is we're going to start to see institutional capital come into the space as we're already seeing it happen. And people are just going to get tired of buying 3 cap and 4 cap industrial properties. And they're going to say, you know what? These assets have viability. They're here for the long haul. The retail apocalypse is not real. And there has been some consolidation in the space, but this is just as viable because I get a lot of the same benefits that I do, say, in industrial space or medical office, and I get it at a higher cap rate. So we think that that's going to play out over time and that we've got a lot of tailwinds at our backs from an upside standpoint. So here's what we're going to be going after in the fund. There's already 3 assets that are in the fund. I don't know if Tom from the marketing team has them up here, but we've seeded the fund with 3 deals already in Q4 when we launched. So we're going after core add and value add type returns. These deals have to have upside. We're not doing any core deals in here. We want to find something that allow us to push IRR, leverage the platform, make higher adjusted returns for our partners. Got to be institutional quality assets, no small deals, no one-offs here and there, minimum typically $12, $15 million. Daily use, necessity-based experiential type tenants. We're not going after tertiary, enclosed malls in the Midwest. We're going after daily needs type centers, the real core center of all the communities where people live. Got to be the number 1 or number 2 property in the submarket. We want to see if we're going after a deal with an anchor in place, the number 1 or number 2 anchor in that market. Too much risk for us to go for a tertiary type Grosso or anchor. So we want the number 1 or number 2. We love national tenants. We also really like secondary markets. You go to certain markets like South Florida, where I live, or certain markets in the Northeast or San Francisco. And, we don't think that type of real estate buying at 4 cap, even for retail, makes a lot of sense. So we like secondary markets like Columbus, Ohio, or Pittsburgh, or, even the suburbs of Atlanta, Georgia, we've been fairly active in because we're able to buy stuff at a higher cap rate, but we think we've still got the compression to come from a valuation standpoint, and we can add value, make higher returns. We want to be obviously in the dense retail corridors and leveraging off of the platform that I've been talking about here at length. So why invest in the fund? We'll have cash flow from day one going out the door. So if you invested hypothetically today for Q1, you would be getting a distribution. Diversification into a good share of the deals that we're putting together. Compelling equity growth potential. Again, we're going after value-adding core deals. We're looking to increase our equity significantly on each deal, which ties into increasing cash flow. You'll have exposure to national credit type tenants, a nice hedge against inflation, like a lot of commercial real estate is offering right now, but we like the, kind of the recession resistant hedge against a recession as well. And obviously all the tax benefits, we'll be doing a cost segregation here on all of our deals, which will pass through to all of the investors to take a nice paper loss. And for anybody on the call who's not familiar with cost seg, I know a lot of people are, so this may be redundant. We don't do 39-year straight line depreciation on the improvements on our property. We send out an accounting and an engineering team, and they break down all the different physical components. They put it into different buckets. And what you find is that the roof is not 39 years. The HVAC is not 39 years. You put them into different buckets. You find out what their life cycles are. We then take advantage of bonus depreciation and allows us to take a much larger paper loss in the earlier part of our hold. So this is pretty much how it goes down. If you want to get involved in the deal, you request an allocation. We'll get you out documents for you to execute once you fund. We'll start to deploy capital over the coming quarters, as we've already started doing. We'll execute the business plan and keep you updated all along the way. Distributions will be paid quarterly. We'll exit the deal via sale or refinance at the end of the hold period and distribute as we go full cycle on each deal. So if you want to actually allocate into this deal and check out the deal room for more information, it's FNRPfund.com, FNRPfund.com. Top right corner is Invest Now. You can also schedule a call with our head of investor relations, Ken Chapman, our fellow managing principal, my partner, really can walk you through any questions that you may have. And that's it, FNRPfund.com, and we can get you out documents, as soon as you like. We're raising money actively. Again, it's a $50 million fund. And here are our targeted returns: 12 to 18% on the IRR, 6 to 9% average annual cash distribution, 3 to 7 year hold. That's at FNRPfund.com. So Jeremy, if you're still there.
Yes, sir. I am here. This has been a great presentation. We got several questions, and I imagine we're going to have a lot that come in. So Robert wants to know, what is the portfolio mix between low-cost grocery offerings to organic high-end?
I would say, we have a couple of Whole Foods and type centers, but we really focus. We're not really going after super high end, like high street retail, where guys are paying $80 rents in the suburbs. We're focusing more. I don't want to say blue collar, but it's really daily needs type of retail. We love to see grocers that are paying a very, very low rent, so we know that they probably have low occupancy costs and that perform really, really well. So. I think we've got 8 Kroger deals in the portfolio, so I wouldn't say Kroger is a super high-end player. We're doing a Publix deal right now in Alabama, but we do have a couple of Whole Foods deals, and we've got some assets like outside of DC in really, really good markets. But I think it's more. I hate to use the word blue collar, but that's really what it daily needs type of retail, Jeremy.
All right. Is the product approved at LPL?
The product is not on LPL's platform.
Okay. Next, what is the term of the fund? Are there existing assets in the fund, or will you source new assets for the fund? I know you touched on some of this.
Yes, we will be sourcing additional assets. The deal was seeded with 3 assets, and I can get you information on the 3 deals that are in there, 3 really nice deals that we recently closed on. But we will be seeding them with future assets as we continue to raise money. And we're really deploying money as we're getting it. We're buying about $200 million worth of real estate a quarter. So this is not like a huge fund that we're not going to have deal flow and we're going to have powder sitting there dry for a long period of time. Going into Q1, we have about 120 million in active fresh deals that we can deploy capital into. So we will be adding as time goes on.
Okay. Frank wants to know, what is the minimum to invest?
So the letter of the law, the minimum for like an individual investor is $100,000. But
Okay.
we actually, and outside of the fund we can't do $1031, but we actually can accept $1031 on an individual deal level as well. And we have investors that have 8-figure positions with us throughout the deals.
Okay. Michael wants to know, what parts of the country are you seeing some of the best opportunities?
So we really focus on secondary markets. Not to say we won't go into a major MSA and grab something if we think it makes sense, or if there's a high amount of value add. It's not an issue for us, but we like to have some cash flow going into the deal. So when you step into these 4 cap deals, it just, to us, it's not really the style of investing that we do. We like to do a lot of the diligence up front, and then that diligence kind of tells us where to go after. So we're very, very opportunistic. Now, from a broad standpoint, we've done a lot of deals in the Southeast. We like the Southeast because of the population growth. But if you brought us a deal in, Oregon, and it had all the boxes checked, and we were able to get a lot of intel on the deal, we would easily go after that. Whether it's a secondary market or primary market, we'll dip into tertiary markets, but we need at least 50, 60,000 people within 5 miles from a density standpoint. But we're very, very opportunistic. We've leveraged off of our relationships with the brokerage community, the ownership community. As we speak, we have guys on dialing machines that are cold calling owners, trying to drum up off market deals. When you do that, you kind of are presented with a unique bag of opportunities. So it's not super geographically focused. It really is nationwide, but I'd say typically secondary markets, and we're going where we can find the opportunity.
Okay. What's your approach to sourcing your deals across the country, national or regional broker? I know you spoke on some of that. That's from a mic though.
So we do a lot of different creative stuff. Like this year, we launched a broker of the year, a guy out of Cushman in the Midwest. He sold us the most property. He won broker of the year. Hopefully, these guys compete next year. They want to win FNRP broker of the year. But really, it's just a lot of blue collar work. Picking up the phone. Our acquisitions guys are presenting to different regional brokers literally every day. So we've isolated, say, the top 75 shops that specialize in our product type, and literally up and down the line, they're scheduling 1 through 75. Okay, we'll start with these guys out in the Pacific Northwest, and they go down the list and they make a Zoom presentation, or they fly out and meet with them. They have dinner, they wine them, dine them, and try to really build long-standing relationships with these guys. And once they get down the list to say number 75, we start back at the top and we keep going through. So there's really no secret sauce. The brokerage community has probably been the most fruitful source of deal flow.
Hmm.
But we also do a lot of outreach directly ourselves. We've gotten some off-market deals this year that we think just by buying them off market, that even our market right now, you see industrial multifamily, but the space is so hot right now that you see deals that are being broadly marketed are going well above asking price. And we've been the victim of that in certain situations. We paid over asking for assets because we thought they still made sense at that price. But at the end of the day, when you can grab a deal off market directly through your own labor, it's a nice situation. I think some of the deals that we did off market, we could have brought them out, broadly marketed them as soon as we closed, and got 10, 15, 20% higher than what we paid. So the brokerage community that has been very fruitful for us, and that's really where we're focused, in addition to some off-market direct efforts as well.
RJ wants to know, do you agree that caps have compressed post-COVID? And if so, what market indicators are you looking at that seem to point to continued cap rate compression?
I look at industrial, I look at multifamily right now, and I say, how do cap rates really go much lower? In our space, I believe there's a little bit more room to run. You got to obviously look at interest rates and all that stuff, but I think more institutional capital is going to play out in our space and continue to be put to work in the space. We've seen 100% through the other side of the pandemic that grocery anchored retail has really been in vogue, and we've already been seeing that play out. So I think that there's a lot more room to run here, believe it or not. I don't think we're going to see 3 and 4 cap anytime soon across the board. Obviously, in some of these primary MSAs, you do for the choice assets, but I think that there's more room to run. I think as more capital comes into the space, drives up demand. I mean, we're seeing this day in and day out on assets that we're bidding on. So I think as that plays out, it bodes well for the current portfolio. Maybe not going forward on the acquisition front, but I think for what we own right now, it bodes really, really well.
Okay, you mentioned you kind of have more of a workforce, blue collar kind of slant. What are some of your preferred tenants?
Kroger is probably our single largest exposure. I think we have 7 or 8 Kroger anchored assets. We have 3 Whole Foods anchored assets. We really have like a broad smattering. We have 3 Walmart deals. We have a ShopRite deal in the Northeast. So it's not overly concentrated on one tenant. The thing that is nice though, when you have a couple of these guys multiple times in your different properties, is you're really able to develop that relationship because they know you're serious. They know you have an ongoing relationship. So a group like Kroger, we've really worked hard. And when we see deals, maybe we're more apt to jump because we know that the intel is stronger from those guys. So we're not going, you know what though, we just did a deal actually with a high-end grocer in the Cleveland, Ohio MSA, local regional grocer there. So I don't want to say that we're not buying in areas that have high incomes, because we do have plenty of assets with over 6 figures average within, say, 5 miles. But it's more daily needs type stuff. It's not super high-end product.
Okay. How has the asset changed from your view during COVID? Like, what are the post-COVID changes that you guys are seeing and will take advantage of? I know you spoke to some degree about the hybrid, but what other things?
Yeah, so from a pure performance standpoint, our assets have done really, really well. I think it's not uncommon to see 20, 25, 30% increases on these anchor tenants from a year-over-year revenue standpoint. And unlike multifamily, which obviously you see rents are exploding as well, in commercial and in grocery anchored space, the increases in rents aren't going to play out for a couple of years. So it's kind of a lagging indicator, but I think it's a good spot to be in, because anytime you see tenants across the board going 20, 25, 30% higher, rents really only have one way to go, in my opinion, and that's up. Because as their performance goes higher, they can afford to pay more rent. The space is going to be more competitive. So I think it's a little bit of a lagging indicator because you're signing longer term leases with these tenants. But as people start to backfill and you see inflation and stuff going higher, um, I think that that's going to play out and we're going to see rents going higher. So from a performance standpoint, not to say every single tenant in our portfolio in COVID did well, because we lost maybe 4 or 5 tenants and we didn't get crushed. But some people obviously were negatively impacted. I'd say the lion's share of the grocery anchored space in our portfolio actually was a benefactor of COVID. When I talk about the shifting of these assets into, I wrote an article for Forbes called Stop Calling Them Shopping Centers, and I still do, but they're really going to become, broader commercial real estate assets is the way that I see it play out. And this is not anything new. This has been playing out. But when we start to see different uses that are coming into our space, it shows that the retail center has more utility than just somebody selling women's dresses out of the storefront. So I think that that's going to play out over time. I think you're going to see inflation and rents going higher, which is going to drive net operating income, which is good for assets that are currently owned. And I think it continues to play out as viable institutional space, more so as time goes on.
You just mentioned inflation. How do you factor that in?
So anytime you're signing a lease that's longer than 1 year, you're definitely going to have a lagging situation because we can't just step in there and say, hey, we're increasing, like I've seen some people in South Florida, they're increasing rents 20, 35% to their tenants in the apartments year over year. You're not able to do that in commercial. While that pent up force may be generating behind the scenes, the chicken's eventually going to come home to roost, and you're going to have that big reset eventually. It's going to take longer to play out in the commercial space, but I think broadly vacancies, you're going to start to see rents go higher and higher. It's just a natural part of the progression. If tenant sales are going to explode, if the price of goods is going to go higher and higher and higher, rents have to go up. It's just kind of the laws of gravity here. So I think it bodes well, actually. If you can get in here at a nice cost basis, make your money on that cost basis, everything else is kind of gravy. And I think real estate, not just grocery, but I think real estate overall is going to be a good place to park money, especially when you can buy at 6, 7, 8 cap rate, arbitrage borrowing money at 3%. And I think it's good defensive type of investing.
Can investors use the 1031 exchanges?
So in the fund, you can, but we do take 1031 money in the individual syndicated deal. So the fund, it wouldn't be eligible, but if you do have a 1031 and you want to take a look at the inventory of stuff that we have, definitely go to FNRPfund.com, schedule a call with Ken, tell him that you were on today's webcast, and we'll kind of fill you in with what's in the pipeline. And if we can accommodate you and have you isolate a deal, we'd love to have you.
What about investing through IRAs?
Yeah, IRAs are fine. Any legal entity is fine. Trusts, LLCs, corporations. If you use an IRA and you're an individual investor, though, you have to use the self-directed custodians. And I'm sure if you don't have a relationship, most people do, we can provide a couple preferred people that we work with. And that's it. Try to use the self-directed custodian and distributions will go to your IRA.
Okay. When someone invests, when can they expect their first distribution?
So if you invested in the fund today, let's say you invested in the fund today, or let's say you invested in a individual syndicated deal this month and it closed this month, the first distribution, because we're at the end of the fourth quarter here, will go out for Q1. So we do our distributions pretty straightforward on typical quarter, business quarter year. So for Q1, it'll be January, February, March's performance will be distributed by the second or third week of April, and then we'll follow that pattern moving forward. So the only reason we wouldn't distribute is if you invested like right now with two weeks left in the quarter. It probably wouldn't make sense. So we'll just do if we closed on something or you invested now, we would just accrue whatever's going on now and then pay it out in Q1.
And can people reinvest those distributions?
Yes, they can. The actual genesis for us doing this fund was because our partners wanted to reinvest their distributions from the individual deals into the fund. And we've seen an overwhelming amount of our partners that want to do that because you can't reinvest back into an individual deal because you don't have the capital needs. So this is kind of why we created the Opportunity Fund, was to just service our current partners. And the interest has been really strong since we launched it. So I think it's something we're going to continue launching future funds as well.
So over the calendar year, how many investments do you typically make or are planning to make?
Really we kind of play the hand that we're dealt. Q3, we did 270 million in deals. Q4 we did, I think we're like for this quarter 214 or 208, something like that. So if opportunities present themselves, we'll go after them. From a historical standpoint, these have been our two most active quarters, the last two. I think we did, 14 to 16 deals in the last two quarters. Middle market deals, 12 million, 25 million, 30 million. But whatever, we don't really have a capital issue. It's all about the deal flow. We've gotten to a point now where we've got some really good partners that are working with us. They believe in the model, who we are. They understand the team and what we're going after. It's all just sourcing deals now. So we've been investing heavily in the acquisitions team. We brought in a whole new revamped underwriting department in Q3. It's been incredible. I can't believe we didn't have it, the way that we're doing things even a couple quarters ago. We brought in a new director of acquisitions to cover more territory. We've got two more young guys that we groomed to come up and support the current directors of acquisitions. So, we're laser focused on trying to source as much deal flow as possible. And we're trying to say no as much as possible as well, because we really want to go after deals. We think we're at a level of sophistication of the platform where we can try to hit more home runs. And we want to continue to get better on the real estate side as well. So that's just kind of playing out, and it's all about finding a deal at this point. So to answer the question, if I was a betting man, I'd say in Q1, we'll probably do between 5, 7, 8 deals, something like that.
Nice.
But very well could be less, could be more.
So your deals have been selling out very quickly. Will the fund get first access?
So the fund is not being deployed into every single deal. We're kind of picking our spots here and there. So they're not going to get, the theory is the fund gets first access to the deals, but we're kind of deploying them. We're doing some of the core deals that we did, because we did do a couple core deals. The fund won't participate in those. They're going to focus more on evaluating the core area deals. It's kind of just going to be on a case by case basis.
Okay. Will investors still get depreciation?
Yes, they will. It's an LLC fund structure, so that's just going to pass right through to you. So, you'll get the depreciation on your K1. It'll just flow up through the fund and then flow down to your personal K1. When we get the K1s out on time, it's very important to us.
So you mentioned you have a platform and you have this fund. So are these deals, people can go and handpick their own deals as well as the fund? Because someone wants to know, will they get to pick the deals they go into, or are they picked for them? Can you speak to that?
I'm referring to a platform. I'm not talking about like CrowdStreet or some equity funding platform. I'm speaking broadly about our real estate operating platform. But we do have the ability, you can pick and choose. We got started with individual deals, and a lot of our equity partners prefer individual deals. We launched the fund because a lot of our partners also didn't want to pick individual deals. They didn't have the time to go on a webinar, due diligence on a deal, and they liked who we were. And, a lot of guys wanted to reinvest their distributions as well. So that's really the genesis of the fund. We don't lock people out and say, hey, you invested in the fund, you can't look at the syndicated deals. And we don't say, hey, you have to get into the fund to look at the syndicated deals. If you went on to FNRPfund.com, schedule a call with Ken, he can kind of walk you through the deals that we have live right now that we're raising money for. We've got 2 really nice deals in, and you can look at those, even if you wanted to build a track record and think about going into the fund. But we're kind of flexible. So we've got the 2 lanes that you can choose, and some people prefer one over the other.
Are there any individual deals that they can learn more about?
So we actually have 2 individual deals. One I don't want to talk about because we're just finishing off due diligence, and that'll be live probably in a week, 10 days. It's actually in Texas. It's a really hot deal, nice value add deal, and it's got a good story to it. And then today we actually launched a Safeway deal in the Baltimore DC MSA, which is a high performing deal, short term hold, good IRR, and that deal we're targeting 15%. And we try to be conservative with the underwriting and set a bar that we can jump over. We're not like these guys I see on I've invested on a few of these platforms, and they're targeting 25 and 30% IRRs, and they very well will hit it, but we don't really like to do that style of business. So if you go to the deal room and schedule a call with Ken, or if you go to FNRPUSA.com and just fill an account, you can get access to the current deals that we have that are live, individual deals.
When you hit the 50 million in capital raised, do you start returning all distributions?
So the way that the return of capital is going to go down is as we exit a deal, we're going to distribute proceeds. So let's say the first deal we closed on, which I want to say is like 90 days ago, no, 60 days ago. let's say we close that deal first, all distributions are going to go back. That deal exits, boom, all distributions are going to go back to the partners pro rata. As far as deploying the 50 million, yeah, once we hit the 50, we'll probably launch a new fund.
Okay. How long will the fund cycle be?
So, we're investing right now and we think we can raise the whole fund in like 6 months probably. So add 6 months to that 3 to 7 year focus and we're already almost a quarter in. So that's kind of what the target is going to be.
I know we answered this before. Someone else asked, is the product approved at LPL? And if it's not, how can they invest?
The product is not approved on LPL. We'd love to get it onto the LPL platform. It's probably be a good distribution piece for us, but we're not approved on there. If you want to invest, you just invest directly with us. And
Okay.
if you have questions how that works, you can schedule a call with us at FNRPfund.com, and it's pretty straightforward. We get you or your client out offering documents, and then they facilitate it. Filling out the paperwork, and we close, and we get you closing docs, and then distributions start going out.
We've had several requests for the presentation. Are we able to share it?
Yeah, absolutely, no problem.
Okay. Someone asked about the recap. We should have the recap up early next week. Can you give everybody your contact information again?
Yeah, my personal email is agrosso, that's Grosso, agrosso at FNRPusa.com. agrosso at FNRPusa.com, and I'm happy to hop on calls, talk to anybody individually as well. Ken, who I've mentioned about 100 times on the presentation, is dedicated to just speaking with investors. He can talk at a very high level. So his calendar is dedicated just to that, but I'm happy to hop on call, speak with anybody as well. If you shoot me an email, I will, happy to talk or answer any questions.
Okay. Are there any other questions or anything else you'd like to say?
If you don't have any other questions, I just want to say thanks for stopping by and checking out the presentation. We got a lot of good things going on. Would love to start a dialogue, even if you don't get involved today or tomorrow. Would love to have a long-term dialogue with, your audience. And thank you so much for having us, Jeremy.
Awesome. We've gotten a lot of interest, a lot of great questions, and I will pass on the people who asked to have the presentation sent to them.
Perfect.
All right. Well, we enjoyed having you and look forward to having you guys up here again.
We'll be back. Thank you so much.